Hello everyone, welcome back to another episode of the Revamped Founder. In this episode, we have Martin Tobias joining us. He's the founder of Incisive Ventures. He is a serial entrepreneur who has invested in 250 companies as an angel and half a dozen as a venture partner at Ignition VC in the past, and is also a limited partner in over a dozen VC funds. He's the founder of leading angel network Element 8, and as a venture-backed three-time venture-backed CEO, actually, he has experience from working at Microsoft, Accenture, and has raised over $500 million, including two IPOs for his own companies. And in this episode, we talk about his love for investing, how he spots billion-dollar founders, and how he spots people who have the potential to build companies that have generational impact. And we also talk about his love for poker and how it correlates with his love for investing. If you enjoyed this episode, thank you. Listen to the very end. So, hey Martin, I hope you're doing well.
Hi, I am. Thanks for having me.
Yeah, it's a pleasure to have you on. Now, I'd like to kick this interview off by asking you, what all funds and companies have you been a part of in the past?
Oh, wow. That's a big question. As an angel investor, I've invested directly in about 270 companies. I'm also an LP in 17 funds, including companies like August Capital, Incisive Ventures, RRE Ventures. And as a CEO, I've been 3 times a venture funded CEO, including Laudai Technology as an cashless and Imperium Renewables, which was a biodiesel company. So I've done a bunch of stuff, both sides of the aisle as an investor and a founder. Some of the companies that I invested in directly are, companies like DocuSign and Jeeves, which is a Brex of Latin America, OpenSea, Deal, which is a employer of record. And, I've been doing this for a very long time. My first venture fund that I was an investor in was Ron Conway's Silicon Valley Angels, and they were in the Series A of Google. And so that venture fund gave me some Google shares at the IPO, some of which I still own. My cost basis is like 50 cents on Google. And that's been really a lifelong reminder of the power of, getting in early to support some potentially transformative technologies. And that's just really animated me and excited me in this whole technology space. And, when I was working, my second job out of college was at Microsoft, and I was there before the IPO. And, if you held that stock for that whole time, it would be really amazing. I still own some of Amazon shares that I bought at $6 in 2000. And, the compounding effects of being in a company that's transforming an industry over a long period of time are amazing. And that's why I'm excited to keep doing it as an investor now, trying to invest in the next generation of transformative technology companies.
Yeah, that's incredible. So, which sides of the coin did you like more? The founder side or the investor side?
Well, it's really 2 totally different things. I think I have made more money as a founder because you end up owning sort of more of the company. But the lifestyle of a founder is very different. You're, full-time for a founder is 80 hours a week. And, full-time for an investor is 40 hours a week. So that's, like half-time. I'm an investor now because I want a little bit more of a work-life balance and spending, I want to have lunches and dinners with my kids and be able to travel when I want. And so for me now, being an investor is a much better fit with the kind of life that I want to have. I also think I can be incredibly helpful, to first or second time founders, having been a founder 3 or 4 times myself. I think I'm a big help to founders, whereas I wouldn't have been as big a help, 20 years ago when I was only a first or second time founder myself.
So, from Microsoft, how did you get into angel investing?
Well, basically, I was at Microsoft before the IPO. And then, when the IPO happened, I made some money. And I was actually working in a group at Microsoft that was helping figure out enterprise software distribution and figure out how they initially did digital licensing to the enterprise. And I was on a team that was working with a lot of startups in the digital rights management space at that time. And there were a lot of companies doing innovations for digital distribution of software, something which is standard today, but which at the time, they were still making boxes of CD-ROMs and shipping manuals. So there was innovation to be done there. And I met a bunch of these companies, and a lot of them seemed like they were having more fun at what they were doing than I was having at Microsoft at the big company. So I'm like, hey, and some of them were raising money and asked me to invest. And I said, okay, I'll invest in some of those because, you guys look like you're having a lot of fun. And then I met Ron Conway and invested in his fund, who introduced me to a whole bunch of other funds. So I got started, because I had extra money. In order to be an investor, you have to have some extra money that you don't need anymore. And, I got that from Microsoft.
For angel investing, you have to have a lot of personal money. But if you are a GP or a general partner at a fund, then you use the fund which you have gotten by the LPs, or limited partners.
Yes. But there's, the only way to raise a venture fund is you have to know a bunch of rich people who also have extra money that they want to put into your fund and have you manage on their behalf. So it's a little bit of a catch-22. I would encourage, people starting out with angel investing to start on something like AngelList. When I started angel investing, the minimum amount you could invest was $25,000 per company. And, you need quite a bit of money to, build a 10, 20, 30 company portfolio at $25,000 each. But on AngelList, the minimum is $1,000. And so you can build a 20, 30 company portfolio for the cost of one company, 20 years ago. And I would recommend that angel investors start on AngelList and joining some syndicates and, investing in companies that they like. You're going to get a lot of information about the companies, and you're going to get a lot of access to a lot of companies that you would never meet yourself in your local town. And you get to read a lot of decks and see what kind of companies are raising and which ones are successful. I think that that's an amazing thing. And there are other countries that have other, networks besides AngelList. You can invest on Republic and Seed Funder and other crowdfunding sites as well. But I would start on AngelList if I were restarting as an angel investor today.
Yeah.
You get to see a lot of companies, and you get to see them on a, deal by deal basis. You don't have to commit your capital. If you join a venture fund, you are committing your capital regardless of what the manager is investing in.
Yeah. So at a venture fund, not every person has to commit his or her own capital, right?
Well, like I have a venture fund that's $10 million. I have 500,000 of that is my money. So I'm an investor in the fund as well. I'm one of the largest investors, but $9.5 million comes from other individuals and family offices and, fund of funds and investors like that who like my thesis, like, the kind of companies I'm investing in and want to invest with me.
Yep. We'll get back to this in a little bit, but I want to ask you, so you like poker?
Yeah, I love.
How does it relate with your love for investing and venture cap?
Well, I think they're very similar because investing venture capital is, and the different stages that you would invest in, the angel round versus the pre-seed versus the seed versus the Series A. You're talking about a low information environment and a low probability events that have high potential outcomes. And you get more information at each round. And that's very similar to poker, especially Texas Hold'em, where in Texas Hold'em, all you know in the beginning is what your two cards are. So you have very little information. You don't know what anybody else has. You don't know what cards are on the table. So you have to make a decision to deploy capital with very little information, only the two cards you have. And that's very similar to an angel check, right? There's a guy with a deck and he's got an idea. He's got no product. He's got no customers. He's got no revenue. And so you have only a very little amount of information. And in order to get more information, you have to pay. You have to invest in the company. And then at the next round, when they raise more money, which is like the flop in poker, you have 3 cards. Now you know the 3 cards, whether they match the 2 cards in your hand, so you have more information, but you had to pay for the privilege of getting more information. And then you have a second decision to make. Do I want to put more money in? Did my odds of making money get better or worse? And it's very similar in investing. If you invest in an angel round and then they go to raise their next round, you have more information about the company, and then you have another decision to make. Do I want to invest more money into this company or not based on the new information that I have? So I actually think, playing poker is very good training for investing, because in a night of poker, you'll have, 300 or 400 decisions with incomplete information as to whether to put capital to work or not. That's like making 300 angel investments, but the stakes are smaller and the decisions happen faster. So you can train your brain to make good risk-adjusted decisions in poker much faster than you can in angel investing.
So you must be one of the best at poker than I guess.
I've played a lot of poker, and I have a positive enterprise value return on my poker playing, similar to what I have in my investing. Yeah.
Awesome. Now you mentioned a small part about betting on the founder. So what do you look for in a founder when he basically he or she has nothing?
So you basically are betting on 2 things. One, the founder, their ability to build the product and to enter the market. And the second thing you're betting on is, is there going to be customer demand for whatever the founder wants to build? So the first thing is, who is this founder? Are they credible? Have they built anything in the past? Do they come from a similar industry? Do they have any experience building or the kind of thing they want to build? And what kind of team have they attracted? Are they able to attract top tier players? One of the most critical skills of a founder is to be able to attract top talent to work for them. And you want to see proof of that, whether it's in this company or at a prior company. And then the second thing you want to do is do a little bit of diligence around, can they get into the market? Because the problem that every company has, regardless of their idea, is they're going usually into a crowded market. And do they have I call it a thin edge of the wedge? Do they have some distribution trick to get their product in the market? Are they a member of a community of industry leaders around this problem, and that community will buy the product? Do they have a big Twitter presence or blog presence or media presence that will allow them to get cheap advertising for their product? There has to be some distribution trick of how they're going to enter the market. If the only way they're going to enter the market is spend a year building a product and then run Facebook ads, this is a very bad strategy.
How do you digress at that stage?
Well, you ask them the question. You go, how are you? What's your market entry strategy? How long does it take to build your product? What's the minimum viable product that you think people will pay for? And how are you going to get it in front of customers? How are you going to get your first 100 customers? And you have to say, if they have a reasonable thing to say or some trick, I'm going to get my first 100 customers because I'm a member of this 10,000 person discussion group on Discord, and 1% of them will buy my product. That's a fairly reasonable market entry strategy versus, I'm going to get my first 100 customers by doing Facebook ads.
Yeah, naturally.
Right?
Yeah. That's a good point. So what do you think separates good founders from great founders at every stage, actually?
At the pre-seed phase, it is resilience and grit. You're going to get punched in the face a lot, and people are going to tell you no a lot. At the pre-seed, founders hear no 99% of the time from investors. If you don't have resilience and some ability to roll with the punches, you're going to get discouraged very quickly. And I ask founders for proof of that in prior businesses or projects that they have done. where the odds were against them, because the odds are against you very much in every founder. So they have to be resilient. And then the second thing is that they have to be great at attracting talent and focusing on what's important in the short term. And so they have to be present and near-term focused. So I love so the great founders will tell you, exactly what they hope to do in the next 3 months and 6 months. And they'll also be resilient enough to want to be able to pivot based on customer or market feedback and, keep iterating until they find the perfect product market fit. Bad founders will tell you, I'm going to do this and, here's my exit plan in 5 years. We'll talk about something 2 or 3 years out. Great founders don't care about anything over a year because you can't do anything about it. Right? They care about what's right in front of them, and they're really good at prioritizing the work to work on the most important things, right? That really matter. And they should be able to show you that they've done that on some project in the past.
So how do you think do great founders develop this ability or these abilities actually?
Just by, working. Sometimes you can develop it, around a hobby. I love almost every great founder that I've met, and I met guys like, Elon Musk and Steve Jobs and Bill Gates. They are in some ways sort of like almost autistic in terms of their ability to focus on something that they're interested in. They can, you look at a guy like Elon Musk, he gets curious. They're fundamentally curious people that go down the rabbit hole on something they're curious on. He can tell you the details of how to build an electric car, also how to build a rocket, also how to dig a hole, but it's because he thinks from first principles and goes down the rabbit hole on anything that he's interested in and will become an expert in a short amount of time. Bad founders or sort of, second tier founders, they won't be that curious or interested in either the problem they're solving or anything. I love founders that have like some weird obsession, video games or, collecting watches or, a particular workout that they like or a health regime or something like that. Great founders tend to be incredibly curious people and go down the rabbit hole on multiple things and are, curious about many different areas other than the one they're building in. So I ask founders to tell me things like that. Like, what's the last rabbit hole you went down and why?
And what is the answer that you get?
Well, I get different answers. If I get the answer of, I don't know, or there's nothing, that tells me this is not a fundamentally curious person. And to be a great CEO, you have to be fundamentally a curious person.
Yeah, that's an incredible thing. I mean, I
just generally, right? Just generally curious.
About everything.
Another question that I ask is, I'll sometimes ask one of these weird questions, because the way to find out if somebody's fundamentally curious is to ask them a question which is outside of their probable area of expertise right now. Like, for example, I might ask a question of, why is a manhole cover round? Let me ask you, why is a manhole cover round?
Because manholes are usually on the side of the road. So it would be easier to spot a circle and differentiate them from a square, but a person walking by.
How would you find out more about that?
How would I find out more? I would study the history of manholes, because they might have been of a different shape in the past. Who knows how it progressed? And in the moment, I would try to look at the geometry of a square manhole or any other shape and circular manhole.
Mm-hmm.
But yeah, I'm still thinking.
What I'm looking for when I ask that question is the person, this is a question they've never thought of before. And is their response fundamentally curious? Like, oh, that's interesting. I wonder, I would like to know that. I would Google it. I would research it. Here's one or two ideas that come off the top of my head, but yeah, I'd like to know that. That is potentially a good CEO. If they answer, I have no idea and it doesn't matter to me because I'm building this other thing and let me keep telling you about it, this is a bad signal in my mind. It doesn't matter that you don't know the answer. What matters is what's your response when you are faced with something you don't know, because you're going to have that happen to you as a CEO every day.
How is my answer? My answer.
You were mildly curious about it. You did not say that you would Google it, which I would have expected, because that's the easy way to answer the question now.
Yeah.
The actual reason is they're round because a circle will not fall through the hole. If it was square, a square could fall through the hole and hit somebody on the head. The other reason is because they're incredibly heavy and you can roll them instead of carrying them. If it wasn't a circle, you couldn't roll it. It'd be hard to move it. Those are the two reasons why it's round.
That's interesting. Actually, I would have Googled it after this conversation.
I'm sure you would have. But, I love that kind of question because it's like, I don't know. That's kind of interesting. Why are they all round? Why have I never seen a square manhole cover?
Yeah. I think I have seen this question that Google interviewers ask this question. So I think it's mainly because for the reasons you said.
Yeah.
Test the curiosity.
Mm-hmm.
They're not seeing how smart the person is.
No, you're not, because you don't expect them to know that. But what is going to happen is they're going to be faced with, questions that are outside their area of expertise every day. And you want to know what they're going to do.
Yeah.
I remember I asked that question to somebody who was a PhD in computer science. And his answer was, I don't know, I don't care, that doesn't have anything to do with my job. And I didn't hire him. And he would have been a terrible employee because that would have been his response to every new challenge at his job.
Yeah, exactly. I think the main reason is because for the PhD guy, he might have been of a certain age. So this is I don't know if it's a taboo or something. After a certain age, you cannot learn new things. You know a lot.
Yeah. Also, if you're a PhD, it's one of those things where you got really, really smart about one small area that you had to do your PhD in. And you probably got that way by ignoring everything that was not in your PhD. And if you're going to have this person doing anything which is outside their PhD, this person's going to be a disaster.
Yeah, for sure. I got even.
That person should probably be an academic and teach more people about that one specific topic, because we need people like that. But that is not a CEO. A CEO is a generalist who needs to understand finance and product management and HR and legal and all of these areas that they're unlikely to be an expert in any of them.
So now I'll pivot here a little bit. So what is venture capitalism? And
venture capital,
how has it evolved from the time you got into it and now?
Well, venture capital is a much bigger business than when I was in it. I mean, when I raised money for my first company in Seattle, there were 3 venture capitalists. There's probably 30 venture capitalists in Seattle now. So it's a much bigger business today. And what venture capital basically is the investors that provide risk capital to entrepreneurs who want to build something that's transformative. And they do it in the form of equity investments in the company, so they have a upside in the success of the company. It's a critical tool which is part of the American capitalist system. It is also a tool which has expanded and grown quite a lot in Europe and in India and other countries. But America still has, 10 or 20 times larger community of people doing this kind of investing. And I think it's one of the pillars that makes our capitalist system able to generate innovations at a pace that is much faster and much richer than any other country on the planet. It's a key component because if you have an idea, there are people that will give you money to try out your idea. And that doesn't happen in every other country. In most countries, that's an incredibly hard thing to do, to convince someone to give you money to try an idea that may or may not work.
What is private equity funding and everything else?
So the difference between venture capital and private equity, venture capital usually invests early in an idea's life cycle. They usually take a minority stake in the company, 10, 20%. And they do it before there's even a product or any revenue. Private equity generally is buying companies much later and usually buying a controlling interest in the company. And they care about cash flow. And what they're doing is buying a company that's doing maybe, $100 million in revenue. They want to come in with their own management and hire different people and put it together with another company, do some financial engineering, cut costs or something like this. So they're very hands-on in changing the company itself, owning a majority of it, and then selling it to somebody else, either in an IPO or another private equity firm. So private equity tends to want to take a controlling interest and really re-engineer the business. Venture capitalists take a minority interest and really let the management, help the management try to build something from scratch.
Yeah, so like BlackRock and Vanguard.
Yeah.
So we're talking about PE funds come in a later stage of the company. So for VC, how early is it too early to invest?
Well, every VC has a different, stage that they like to invest in. And that's something that a lot of founders don't really understand. If you're Tiger Global Management and you have an $8 billion fund, you cannot write a check smaller than $20 million. So you're writing checks into, Series B or C type companies, pretty mature companies that are 5 or 7 years old. If you're a fund like me and you have a $10 million fund, you're writing $250,000 checks. You can write smaller checks very early, even the first checks into a company. In fact, that's all you can write. You can't write the later stage checks. So one of the things I encourage founders to do is to do some research on the VCs you might want to talk to and check their stages and average check size and stuff like that, and make sure that you're at the right stage for the kind of companies that they like to invest in, because not all VCs are the same. Some VCs have a higher check size than you may want to raise or have a later stage. And but there are VCs specializing in each stage of the venture capital journey.
Yeah. So why did you decide to raise $10 million? Why not more?
Well, because basically there's a saying in venture capital that your fund size determines your strategy. And that's absolutely true. If you're going to write small checks very early, like in pre-seed, companies are generally raising between $500,000 and $1.5 million. And that is generally done by putting together 3 or 4 funds at $250,000 to $500,000 each. A check of that size, if you have a $100 million fund, you cannot write a $250,000 check. You have to be writing $2 or $3 million checks into each company. So you have too large of a check in order to do that first institutional round. If you are wanting to do the first institutional round, you have to have a check size of, $150,000 to $500,000. And, if you have a fund bigger than $20 million, you just it's going to be hard to deploy that many $250,000 checks, right? So as your fund size gets larger, you end up having to have more partners and do later stage deals. And many VCs want to do that. Many VCs want to do pre-seed and seed and A, and that's fine strategy. And if you want to do that, you need a larger fund. I don't want to do that. I just want to do pre-seed, the first institutional checks into very early companies. Because for me, that's the most exciting part of the venture capital ecosystem to invest in. So you don't need a large fund to do that. In fact, if I had a larger fund, it would be harder to deploy because you would have to write more checks.
Yeah. So is there an advantage that comes with writing the first check in a company?
Well, the advantage is you're the first investor, and if it works out, you're going to make more money than anybody else. If it doesn't work out, you lose less money than the later people. So
yeah. So how do you value companies at such a such a young stage?
Well, I mean, I was just on the phone with a company today that does startup valuations, and again, going back to poker, you have to make a decision with very little information, and you have to make a decision on the valuation, the management team, the market entry strategy, all these things. And it's a lot more of an art than a science. Mostly if you're a professional VC, in pre-seed, you're really looking at comparables, other companies that have raised money with similar management teams in similar spaces. And there's a range, but you just need to basically agree. I mean, these deals get done when the VCs and the CEO agrees on a price, and they may have differences of opinions, but when they agree, a deal happens. And for me, I'm willing to pay a higher price for a better team, a more done product and stuff like that. But there are no hard and fast rules. It's all, at the time, what are the comparable type of companies raising money at? And that has changed. Basically, in the last 6 months, the pre-seed and seed valuations are down approximately 50%, which tracks very similarly to what happened to public company comparables. Public company SaaS multiples went from sort of 15, 16x revenue to 5x revenue. They're down, 70%. And when the public markets are down 70%, you would expect the private markets to be down 70%. So, or 50 or 60%. So the valuation is all at the end for early stage companies is all at the end of the day related to what the exit or final value would be, which is basically what similar public companies are trading for.
Yeah, that's so how we see it on like Shark Tank. Is VC funding really like that? They really look that intense?
No, that's complete theater for TV. And I can understand investing in companies like they do, like fart candles and snacks and stuff like that, consumer packaged goods, in a 30-minute pitch session and something like that. But to invest in technology companies, that are selling into enterprises, I don't think you can do enough analysis in half an hour to just make a decision as to whether you want to invest. You have to do quite a bit more work. So that's not in reality how software venture capitalist works. You end up 3 or 4 meetings, diligence calls, technical people looking at your code. There's a lot more work that goes into investing in a software company than they represent on Shark Tank.
I think that's the reason why we don't see a lot of SaaS companies that come on Shark Tank.
No, you don't, because you can't make a decision. It takes too much work. You can't make a decision in half an hour.
Yeah.
But you could make a decision on a fart candle. So,
yeah, trade no. Yeah. That's interesting, actually. That's very interesting. So how does the ideal process look like of a company fundraising from pre-seed to IPO if the company goes public?
Well, I mean, the IPO is not the only way to get your money back from the company. In fact, the vast majority of startups either shut down, go to zero, or get sold to other companies. That's the more normal way for companies to end as opposed to IPO. I've taken 2 companies public, but the IPO is simply one more fundraising mechanism. You're raising money to keep growing the company. It's an alternative to the private markets, and there are benefits and downsides of being public versus private. But basically, the ideal path would be, a founder comes up with an idea he thinks is going to really change a particular industry, gets a couple co-founders that give him credibility in building the product, probably a technical founder, maybe a market person that really understands what they're doing, 2 or 3 people. And then, they raise $500,000 or something like that to build an MVP. And then after they build the MVP, get some customer feedback, they raise a pre-seed round of 500 to $1.5 million. And that gets them, into the market with the first sort of 10 or 20 customers and, a couple $100,000 of revenue. And at each stage, what they're doing is raising enough money to achieve enough traction for the next set of investors to want to give them more money to keep growing. The correct fundraising path is you have to raise enough money at each stage to get the kind of traction that the next set of investors want to see in order to give you money. By the time you get to public, you have to have, 2 years of financials, audited GAAP financials. You have to be growing at a certain rate. You have to have a certain amount of margins. You have to have all this stuff in place. So if that's the final goal, there's 4 or 5 steps between here and there, and you need to raise money to keep making each step. Companies that fail are ones that don't raise enough money to get far enough to where they get more money. And that's the vast majority of companies fail because they run out of money. And they run out of money because they don't get far enough to convince investors to give them more money.
Yeah. So do you look at profitability when a founder is raising money? Do you look at the profitability of the company?
No.
Not at pre-seed.
At pre-seed, there's usually very little revenue and there's almost never profitability. But what I do look at is a reasonable path to profitability. The more important thing is margin, and things in pre-seed and seed are things like margins, net revenue retention, burn rate multiple, and statistics like that. They basically are indicators that the company is on a path to profitability. So burn rate multiple is over a given period of time, say the last year, how much revenue did the company add versus how much cash did it burn? And I saw a company the other day that had a 20-to-1 burn rate multiple. What that meant is they were burning 20 times more money than they were adding in revenue every year. That is a road to nowhere. You're going to run out of investor money and you'll be done. Like, this is not the correct path. I have another company that has a 0.65 burn rate multiple. What that means is that they basically added new revenue last year of $5 million of ARR, and they burnt $2.6 million. So they're adding more revenue than they are burning cash. This is an indicator that that company is on a path towards profitability. The second thing is, what's your margin? That company that I just mentioned has an 81% margin. They also have a net revenue retention of 115%. What that means is that they sign up customers for a year contract. At renewal, the customer contract gets bigger. So if you start to see those things early on in a company where they're able to add more revenue than the cash they burn, they're able to increase their revenue per customer on renewals, then you can see the path to profitability, right? That's what you're looking for in the pre-seed, the seed, and the Series A is the path to profitability. Because at the end of the day, public market companies want companies like, Microsoft or Apple that, have great margins, reliable customers, long-term revenue that are basically spitting out cash. The goal of all of these things is to create companies that spit out cash. And the problem in the venture thing is what indicators show you the company's on that path?
Yeah, I was talking to a Fortune 500 founder the other day. he was saying that people overcomplicate things too much. You just have to build a product that people will pay for, and that's how you get successful.
That's pretty much it. Well, the right way to build a product people will pay for is to solve an important problem for them and to provide value. You have to provide more value than you are charging for your product, right? That's what you have to do.
That's what Amazon did.
And products that are not successful, they just simply don't provide enough value for the cost that they're asking for from the market. It could be just an optional thing that people don't really need or a nice to have. That's why I tend to not do consumer packaged goods. Like take the fart candle idea, right? The fart candle idea doesn't solve a problem for anybody. It's just a funny thing that some people might want to buy as a joke. Can that ever be a really big business? People buying for jokes? Maybe, but I doubt it, right? Much better businesses are things which are solving problems for people, like Microsoft Word or Excel, or
Yeah.
Excel is making people more productive. Word is making people more productive. Outlook is improving people's communication to the world. Like, this is things people are willing to pay for because it makes their lives better. Those are the truly innovative technology companies that make a lot of money. Google lets you find anything, right? And it's free.
Yeah.
This is a great business. Facebook lets you connect with all your friends and follow stupid memes that you don't care about. This is a great business. You're solving, but how do you keep up with your friends?
Facebook is kind of in a rut right now.
It kind of is in a rut, but that's basically what happens with all social things. People use one for a long time, and then something else comes along, and now everybody's on TikTok, right? Like, it's hard to create enduring brands in something like social. That's why I don't invest in B2C companies. I invest in B2B software companies, because when you're solving business problems, they tend to be, a little more enduring businesses than trendy businesses. That's why I don't invest in media companies, right? Media companies, games companies, movie companies, things like that. Those are hits businesses. You spend $100 million making a movie. If you get lucky and everybody likes it, you can make a lot of money. If you get unlucky, you lose all your money. It's not related to the value you're delivering for the $100 million. It's related to, do people like it? Which is much harder to pick than, are you solving a problem? Movies don't solve problems for people.
There's a getaway.
It's a getaway. It's entertainment, which is very fickle. And there are people that are very good at multiple times creating, entertainment. Steven Spielberg and guys like that. I mean, there are people who've built very big, very profitable businesses in that industry. I do not invest in it because I don't understand how to do that.
Yeah. So that was. So do you think that B2B companies are more investable rather than?
Yes, they are. And, but again, you talk to different VCs and you'll get different answers. There are VCs that love B2C companies, that are very good at helping B2C companies and picking the next Facebook or Snapchat or Instagram. I mean, I'm not, but I will tell you for certain, there are far fewer VCs like that than there are B2B VCs. The vast majority of VCs would rather you solve a business problem because there's much more budget and reliable customers for solving business problems than there are for, fly-by-night, fanciful applications.
Yeah, that's a good point.
I mean, you can still solve problems for consumers, right? And have a B2C thing. Like if you're creating, like Esurance, a cheaper insurance company that's a digital-first insurance company, or if you're creating like Robinhood, an easier way to invest in the stock market, right? You can still create interesting consumer brands that are built on technology that are solving problems for consumers. The challenge with those is how to get a lot of consumers using it. Are you identifying a problem that a lot of consumers have, right?
I think so. Mainly the bar in B2C companies increases.
Much higher. Yeah.
What are the different roles in a VC fund that a founder should expect to meet with or to have interaction with?
Well, at a big VC fund, you'll probably start with a principal or an analyst, and then they will bring in a partner, and the partners are the only ones who can make decisions. If you don't end up talking to a partner, you will never get a check because those are the ones who vote. The principals and the analysts do not vote. If you're talking to a single VC like me, I do have a venture partner who helps me with diligence, but I make all the decisions myself. If you are talking to a VC that has multiple partners, you many times would have to go, you would talk to one partner, he or she would get interested in it, but then they would have to present the opportunity to all of their partners and the investment committee would have to vote on it. So a multi-partner firm, you have to convince all of the partners instead of just one partner. Personally, it's easier to close investments from solo VCs because they make all decisions themselves.
And what does an associate do?
An associate is a junior person who basically helps diligence and find companies and run events and things like that. You would probably start talking in a big firm to an associate or a principal because the partners are very busy.
So in a fund like A16Z, will there ever be a point where Mark Andreessen actually meets the founder?
It's very unlikely, unless you are doing something that is particularly personally interesting to him. I think they have 40 or 50 partners there. It's more likely that you're going to talk to another partner who is working in the specific industry that you're building in.
That's awesome. Now, just the last question though, what are some of the most used terms or lingo which is used by VCs which the founders should know when raising capital?
You should know what a safe note is and the difference between a safe note and a convertible note. You should know what a preference stack is, which tells you how the money gets distributed to investors. You should know what pro rata rights are, which a lot of investors are going to ask for in future rounds. You should know what information rights are. Investors are going to ask for you to share certain information about the company over time. And you should understand issues around governments and how many board seats there are and who controls the votes. And you should also understand minority protections because basically, if you sell preferred shares in your company, those investors are probably going to have certain override votes despite being minority shareholders. They're going to have the ability to approve or disapprove certain debt deals and employment agreements and M&A transactions. You should understand the minority rights that you're giving up in a financing.
Do you expect a first-time founder to know all these terms?
No, but there are great places to go and learn about that. On Twitter, there is a website called OpenVC, which actually just posted a list of 50 terms that VCs use that founders should know, and they're maintaining that post. You can learn these things. They're easily accessible, and you should, because they're going to be in your documents, and if you don't know what they mean, you might get hoodwinked. So.
Yeah, funny enough, I had Steph, who's the founder of OpenVC. He was on the podcast a few days ago.
Great. He's a great guy. They're doing a good service to help educate everybody, founders and VCs, about how to do this.
Yeah.
All right, Advik, it's been nice talking to you, and thank you for doing this.
Same here.